Good evening, ladies and gentlemen. Is the market just overreacting, or has the apocalypse that the bears have been prophesizing about for years now finally arrived? That is exactly what we're going to be getting into in this video. And usually we don't do 2 daily cryptocurrency market updates within one day. However, given the nature of what the markets are currently doing, it is important for us to keep you guys up to date on exactly what's taking place. And we are going to be explaining that throughout this video. We're going to be starting the video off with 2 takes that very much align with my own thinking in regards to what's currently taking place with the markets today. Now, it is my opinion that the markets are just largely overreacting, and what we are seeing is a readjustment for the markets on the back end of some not so great economic data in regards to non-farm payrolls and unemployment that we got on Friday. So, if you are in charge of funds and the probabilities of a recession based on Friday's data goes up, you are going to hedge that. And that means taking risk off the table, or more of a portion of risk off the table than you already had. So that is going to cause a little bit of a turbulence and a little bit of a readjustment in the markets. And of course, over the past week, the Bank of Japan raised their interest rate for the first time in 30 years, which has caused a major sell-off in the Nikkei, the Japanese stock market. Now, we have been one of the few people to continue to reiterate the fact that the Nikkei is a short yen trade. We're going to be looking at all of that in this video. So, with Friday's data, it's increased the probabilities of a recession. We're not in the recession camp. We don't think we're going to get a recession in the near term. Remember, a stat for you here, guys, is the S&P will rally within 2 months of a recession. So it will rally right the way up and start to price in a recession 2 months out. That's historically been the case. We're going to be showing you all that in this video. So if you are in the bear camp and you think that this isn't an overreaction like I do, and actually the apocalypse is upon us, then you think a recession is in the short term. If you think it's further out, the markets are likely going to recover from this. But if you look at the VIX, the volatility index for the S&P, we saw a major spike. I do think we will see a recovery as this unwinds. It's very common with the VIX. I ultimately think that what you're seeing right now for the markets is a major overreaction. And in regards to the cryptocurrency space being a higher beta play for risk, generally, everything risk-wise is selling off. The dollar is also rolling in the manner that we thought it would, under perhaps a slightly different context. So it's going to be important to play these 2 videos to kick things off, because I think they perhaps explain things a lot better than I can, but very much reiterate the points that we're making and that we made this morning. We think there is a great opportunity ahead of us for the markets, and that the apocalypse doesn't come until later on. And by apocalypse, really, I shouldn't necessarily say apocalypse. I mean a major stock market crash predicted by the yield curve. We are going to be looking at the yield curve. We'll be looking at where we're at, what historically has taken place with the yield curve. We did see for a very brief period of time an inversion of the yield curve. The 2s and 10s is the yield curve that I'm talking about here. We're going to be explaining it all. And it is absolutely my assessment that what we're seeing right now is a major overreaction, and that we are going to recover from it and resume what is more broadly an uptrend for risk, and that this isn't the top for markets and a recession is on our doorstep. Remember, very interesting and useful stat there, that the S&P will rally within 2 months of a recession. We're going to be getting into it all. We've made a number of promises to you guys on this channel, and one of them is we are going to do our best to keep people on the right side of the market. And I think we've done a good job of that thus far. Did I expect this kind of market reaction today on Monday? The answer is no. But everything we say on this channel, we truly believe, and my money is always where my mouth is. I'm a big believer that you should lead from the front. It's been a brutal pullback for the cryptocurrency space since we got into the market back in 2023. We've had many altcoins. Some of them were up as high as 600%. For the first time since we got back in, I'm not doing myself any favors by telling anybody this, since we got back into the markets in January 2023, which is the perfect bottom for Bitcoin, perfect bottom for many altcoins, our portfolio went marginally down, but it is now recovering, and I do think we are going to see a speedy recovery once there's been that sigh of relief to the markets and a broader uptrend is going to take place. The altcoin market hasn't really seen anything yet, but it is to come. And yesterday we spoke about how there was there was no interest in the altcoin market, and we looked at this from a number of sort of social metrics point of view, and I gave my own personal perspective as someone who gets some of the most viewed YouTube content in regards to certain altcoin projects. So let's get into it all. Deep breath, guys. Don't panic. We've got this. Let's go. Let's dive into clip number 1. And we actually played this earlier, and it was to do with the expectations of recessions, the repricing that's taking place, and the ramifications this has on the market. Some people saying, oh, I told you a recession was here. Well, there's no signs of that. In fact, earlier today, we had, let me just find this, ISM servicing. Now, this has actually moved away from that recession zone in a positive manner. I don't think GDP or any of these other metrics we have reflects a recession. Yes, unemployment is to watch. But just like we weren't in the inflation is going to surge in a 1970s style fashion, we're not in the recession is here fashion. We don't think a recession is coming, and we think the markets are very much overreacting. There's a lot of change taking place, and ultimately markets don't like change. They don't like uncertainty, and they will readjust as risk starts to get priced into the market. So let's dive into the first clip that we had for you. We played it this morning, but we're going to be playing it again. Without further ado, let's dive into clip number 1.
Is this a small risk play or a real risk play?
It's certainly the distribution has changed, and in markets that's what matters. So outcomes obviously ultimately matters, but right now the distribution has changed and the market is reflecting that change of distribution. So the Fed, its main aim of obviously its official mandate is inflation and unemployment, but really what it comes down to is it's really trying to prevent these negative feedback loops developing between the real economy and between markets. And what's happening now, we're in that reflexive mode where all of a sudden things are moving considerably faster. So, the economy last week, today, they're very little different, right? Nothing has really changed there. Although you will get people saying, see, I told you so, recession was definitely going to happen. What's really changed is the market, through positioning, has begun to price in much higher chance of a recession, but that's precisely what makes it more likely. And that's why there's going to be extra pressure on the Fed to act. And that's not to say that's the right move in the longer term, that's throwing more fuel in the fire, but the reality of the situation is the Fed is in a sort of invidious position, right? Because if it does nothing, it will get a lot of opprobrium for, maybe not preventing a recession. And if it does do something, it'll get accused of pandering to the markets. But when it comes to this percentage that you're talking about, I think it's actually a little bit lower now. It's more like 20-25% of an early cut. But the problem is if you do get an early cut, by the way, it's unlikely just to be a 25. They're probably going to do something bigger. So again, your distribution has changed and your risk reward is really swung in favor of taking that outlook, because if you're wrong, your downside is very limited, but if you're right, you have a very big upside.
So we played that this morning. It very much echoes what we think the market is going through at the moment in regards to this readjustment on an increased probability of a recession, of course, based on non-farm payroll. So let's go over to that non-farm payroll number before we dive over to CNBC. But it was a good one to sort of pay attention to. Obviously, we had a way lower expectation. He also covers what's going on here, a revision that came way low expectation in regard to jobs added to the economy and also unemployment rate starting to uptick. Now, the reason that this has affected sort of recession expectations is because historically, when unemployment upticks, the market starts to fall. When unemployment is low, markets are high. Unemployment's at a high, markets typically are low. And you can see this is the correlation that we're showing you here. It's apparent. We go with the charts. The one thing that I may add is when unemployment was at a low here, actually the markets were also at a low. So there's been this kind of skew, I think, in regards to this based on the events of March 2020 and obviously the shutting down of things. It's why we've had such good labour results, and that's now kind of teetering off. The question, is that teetering off because of what we've seen historically being true in regards to now unemployment is rising and that means we're entering recession, or is that teetering off because of the kind of spur that we had in regards to jobs now being added to the economy after we were shut down? There's a lot of double-edged swords and landmines about in regards to the markets, and ultimately we go with what is more plausible. And what is more plausible for me is that we aren't in a bad situation in regards to risk and that it is ultimately going to go higher and that a recession isn't in the short term, i.e. 2 months or so out. I think it's a lot longer out. And we'll talk about the yield curve and we'll talk about a number of other things. We had previously mentioned and stated that you will get, and this is a daily time frame which isn't going to help anybody out, the S&P actually rallying within 2% of a recession. So you can see this, it doesn't come really until a recession is on the doorstep. And in regards to the uninversion, we have seen an uninversion, but the uninversion, if you look at the 1920 crash, it took 364 days for it to play out. Here it took 196 days. Here it took 168 days. We can talk about pivots in just a second. But this was certainly what I think is a large part of what's happening today with the markets is you're getting this readjustment in regards to risk. And people are saying, okay, there's an increased probability of recession. Let's hedge that bet, i.e. take off the table. Obviously, today we also have the events of what took place with the Nikkei. So the Nikkei is something that we've been zealously watching in regards to, for us, the Nikkei is a short the currency of that country trade. And if anybody to the Princess Yen or some of these other books, you'll understand how the Japanese sort of economy works, third largest economy in the world, very indebted nation. You can see that the Nikkei has had the worst day in history, or the Nikkei 225, not the index necessarily, the worst day in history. And of course, this is on the back end. If the Nikkei is a short yen trade, as the Bank of Japan decided to up interest rates for the first time in 30 years, okay, well, if the Nikkei is a short yen trade, people are now going, okay, now the yen is going to gain some strength, which means the Nikkei is going to lose ground. There's that kind of seesawing, if you will. This is from Adam Koo. It says the sharp rise in JPY USD is causing a massive unwind of yen carry trade position and contributing to the sharp decline in the US stock market. For those who do not understand how this works, a brief explanation. Many traders were borrowing yen because it's at a low interest rate, converting them into US dollars, then buying US stocks. They were also doing the same thing with the Japanese Nikkei. This is what we mean by the Nikkei as a short yen trade. As they're now putting strength into the yen, you're going to see that unwinding. Now, this has had contagion in regards to the fact that it's translated over to our markets in, oh no, there's a crash happening. There's going to be contagion for this, at a time when people are already taking that risk off the table. You can see one reason we love charts is because we can technically build a picture together. Just like we knew the dollar was going to roll, yes, the context is slightly different, but generally going in the direction that we want it. So this is really what's happened with the Nikkei. So we've got two things. We've got a readjustment of risk, people hedging their bets based on increased probabilities of recession on the back end of the non-farm payroll numbers. Today, of course, we have the Nikkei essentially selling off on the back end of a bolstering or a strengthening of the Japanese yen, which the Nikkei is a short yen trade. Remember that. Ultimately bringing things down. There's contagion in regards to that. And on top of all that, we've got a lot of unrest sort of geopolitically and uncertainty. The Fed are also set to lower interest rates, likely going to do it sooner than expected. There's also uncertainty in regards to that because there's an idiosyncrasy out there in regards to every time the Fed lower interest rates, the markets crash. This is not the case, ladies and gentlemen. Yes, it has been if you look at the dot-com period where they lowered rates, but we were already in the crash when they started lowering rates. And also 2008. If you look at the 2019, which subsequently led to 2020, that did not cause a crash. Actually, that caused the markets to go a lot higher before, obviously, the events of March 2020 took place. If you look at the prior two from that, actually both times the market went on and rallied significantly. So every time they lower rates, a crash doesn't always occur. But there's a lot of uncertainty and questions that and kind of uncertainty the markets just simply don't like. So there's this major readjusting and repricing of things that I think is ultimately being blown out the water. And when it comes to the cryptocurrency space, I think we're going to see a really speedy recovery. It's a drama queen, guys. It likes to react volatilely. We can piece all of this together. There is one thing that I am watching in particular that I can't really give you an explanation for. I am sorry about this, guys. But it is the Lockheed Martin and what this is doing. This is well and truly a breakout. This is a military stock. Could be a sign that there's a war on the horizon. We know we've got news from Iran and things like this. There's also a lot of civil unrest in a lot of countries. I recently watched Keir Starmer's speech, and I'm just outraged in regards to a lot of things. As somebody who grew up in a exceptionally, probably one of the most multicultural areas in the UK, it's really heartbreaking for me to see how they're turning one against the other. And using both sides to essentially fulfill an agenda that they have in regards to implementing new restrictions and measures onto everybody in the UK. We might set up that second channel and do an entire video about that. But there's a lot going on, and the markets are digesting, they're processing it, and their instant reaction is, okay, let's take risk off the table. This has a domino effect. Ultimately, I think you're going to get that sort of resurgence for markets, or we are still, I believe, in good standings. Lots of people also, because people, and I said this in this morning's video, be very careful of the news, guys. It's going to be horrific today. But just take a zoomed out look. Let things settle. You know, if somebody's just chucked a smoke in front of me and I can't see where I'm going, I'm not going to go through it. I'm going to sit, let things pass, let the wind sweep it, and then I'll make my sort of plan based on that. Lots of people talking about how there's record Bitcoin ETF trading. There's actually not. Okay, and the selling largely isn't coming from ETFs. It's going to be interesting to see the dust settling on this. Bitcoin, when you do take that zoomed out approach, I do think is in a not so bad spot. And I still think, and I hate to say it, guys, because a lot of you will be gnashing your teeth at me saying that this is a pullback in what is a broader uptrend. I don't think we've seen that topping structure for Bitcoin. I don't think it falls off the cliff. We don't typically see this. I think, yes, altcoins, not in such an amazing position. This is one of my favorite and largest positions, which is Chainlink. Significant sell-off here, something like Hedera. But they're really just in their accumulation range, and we still think there's a great sort of time ahead of us. The 10s and 2s did uninvert I would say just about, but you still could be a year, half a year out before there's a typical crash that comes, and we are in a very interesting environment. And often an inversion, the markets will actually rally after that, along with rate cuts, at least for a period into an SHIT storm. Let's now dive in to, I think I've covered broadly what I wanted to cover. In fact, there was one other thing in regards to people calling for recessions. This is the ISM services. This is now moved away from recessionary territory. Again, it kind of fulfills, we think the economy isn't in such a bad place, and we think what this is a kind of growth scare, a worry that the markets are digesting and readjusting as a result of. And they always do, they're drama queens. They always do it to more of a degree. But when there's that kind of sigh of relief, which we think is going to come in the next couple of weeks, you're going to start to see markets go. Certainly as the Fed lower interest rates, certainly as global liquidity expands, certainly as technically the targets that we're looking at get moved towards, everything will be back in play, and to a really accelerated degree because of the sort of economic context that we're in. What I want to do now, guys, is play our last clip in itself. Charlie Lee, guys, talking about his view on what's going on at the moment. We'll offer some insight as we go through this, and then we'll look to wrap the video up. So let's dive into the last clip that we have for you. It's important for us to get out there and explain everything as best we can. The one thing that I can't explain, unfortunately, is why Lockheed Martin's done what it's done. That is a bit of a bee in my bonnet, because that does make me think that, okay, an industrial complex stock doing well, why? Everything else I can explain, we can reason, we can sort of put it together. The one thing I can't put together, unfortunately, is why Lockheed Martin is doing what it's doing. Those military industrial complex stocks doing what they're doing, I'm not sure what happened there, guys. Don't get a MacBook, by the way. Not the best laptop, I've got to admit. No offense to Apple, by the way. The one thing I can't explain is that. So let's dive into this clip now. I've been thrown off of the individual that we've got for you, talking about his view on this. We very much agree with it, and we'll interject as we go through it. Let's dive into it.
CNBC contributor. In times like this in the past, it always would help to know, Tom, whether it's a sharp, scary spike down, which a lot of times the other side looks just like it, or people are hoping for that so much that they don't see that it might have longer to go. Do you get the feeling that this is not going to be a major sell-off?
For now, I think it is the former that you described. We have over 3 days, suddenly markets reversed, and Japan down over 20%. And as you're pointing out, the NASDAQ could even decline further. Declines like that are generally symmetric, but you have to watch the VIX. And when the VIX peaks and starts to roll over and fall down, the recovery can be just as quick. I think a lot of this depends on whether financial conditions in the U.S. start to tighten, meaning like, do markets seize up? But with interest rates falling, the consumer's still in pretty good shape. I think on the other side of this, it'll look like a growth scare. But it doesn't mean that
It's a
today's
growth
the bottom.
scare.
Yes.
It's kind of interesting that it almost looks like the market's doing what the Fed didn't do again. It's almost like once again they're there, but not really ahead of what's happening, and they're reacting, not anticipating, kind of again.
Yes.
On the way up and on the way down.
Yeah, the 2 years is signaling that the Fed is behind because 2-year yields have fallen further. But it does seem like, as we look back, a lot more this is because of the surprise hike from Japan and the sort of knock-on effects from there. If that is the primary source of the reaction, I know it's going to be tumultuous for markets. But for the U.S. economy, it's not necessarily bad news. And I think that's why we can balance.
So he speaks about a number of things there. One is, of course, the VIX, which spiked. We can show you the VIX. It did indeed spike. And the VIX spiking is typically not good for markets. Put the S&P. This is the S&P Volatility Index. You can see VIX rises, markets down. It's had that spike. It's kind of out the way of. We've seen this drop. If this starts to come back down, which we're already starting to see, it's going to relieve some pressure from the markets. And again, this turns out to be nothing more than just a kind of overreaction to a number of things. And he mentions if the rate hike causing the Nikkei to kind of unwind and that carry trade to unwind is the main cause of this. Actually, the US markets don't do so badly as a result of it. We see lots of people, yes, it's brutal for crypto. But when we look at the likes of, for example, the SPY, which we've now got 2 SPYs on here, guys, it's really not that bad. I mean, yeah, this is steep and horrible, but so is this one. So is most of the drops in the SPY. It's in a broader uptrend. It's done very well. These highs are still well apart. You know, if you look at something like the DJI, Dow Jones Industrial, which made our target for it recently, it deserves a break. You know, it's having a bit of a pullback. This is a really over-exaggerated pullback that's created gaps that I reckon you fill, and then that can actually fuel you to the upside. The picture isn't really that much of a bad one. For altcoins, yes, if you look at, for example, Bitcoin, it's brutal, but in the grand scheme of things, it's not that bad, guys. And I know it winds people up for me to come out on a day like this and say that, but that's what we're here for. You know, we made that promise to you guys that we'd help you to the best of my abilities. My money is always where my mouth is. There's nothing I am saying on this channel that I don't truly believe and haven't reacted on as a result of it. We've been long the cryptocurrency markets, predominantly the altcoin markets. Could have got Bitcoin dominance trade way better since January 2023. And at times it's been absolutely amazing. At times like this, you kind of go, oh, well, we've been sat for a while now, not really getting that much out. You know, I could have took profits 6 months ago, and I'd have been mega up. But I didn't. You live and learn. I'm not perfect, but ultimately we think the broader trend is still very much intact. Let's listen to the second sort of half.
Well, your great and accurate calls have been based on inflation coming in like you thought, much cooler than the market was thinking at the time. I guess the flip side of that is that there can be the dual mandate. There can be labor market weakness associated with why that's happening. Was the asymmetric risk? Maybe it wasn't asymmetric. Maybe there was a great risk to the job market.
Well, you know, markets don't like surprise. I mean, Friday's jobs report was disappointing.
How far back did they go with revisions down, too? It almost looked like the whole story, the whole narrative that we had is suspect.
That's right. And I think many expected that because, you know, the establishment survey versus household had so many gaps. And so that's kind of converging. But that means markets are waiting until August payrolls report, which is not for 4 more weeks, to really know. But I would say, to me, it still seems like July, even as bad a report it was, is more of an aberration. And I think the trend is still...
Weather, there's a couple of things in it that people...
Yeah, there was almost a record number of people that were having temporary layoffs and people who weren't working due to bad weather. And Texas had a big spike in jobless claims. So it does look like the hurricane had some effect, although the BLS said there was no effect.
So rather interestingly, in regards to that non-farm payroll number and the unemployment number, there was a lot that went on there that wasn't quite the full story. If you start to see unemployment start to come back down and jobs started to be okay, that's really going to fuel things, certainly at a time when rate cuts drop. You know, the main premise of this, guys, is to offer an alternative to what the mainstream is currently pushing right now, what everyone's pushing right now in regards to a recession's here. I've heard people call this a black swan. Okay, the Nikkei is probably experiencing that on the back end of the rate increases. But I don't think that's the case generally. I really don't. And I think when I look at things, yes, we're having a pullback, but that's really just all it is. And there was a lot that went into that non-farm payroll. Let's finish this interview up.
On Thursday night, one of the people at your shop said 53.90 looks like a good S&P support. Do support levels mean anything? And you want to give me another one, or is it just another one to go through?
Well, because it didn't hold, it means that there are other support levels that could be important.
It might not hold.
Yeah, it could not. I think that the VIX is telling us that.
We gotta watch the VIX.
Yeah, because it spiked Friday and then it's spiking again today. I mean, the last time the VIX was at this level was April 2020. So for an investor, that tells us kind of where we are, which is we know markets are nervous and they have to unwind, but it's not been a bad time to be thinking that there is a big opportunity on the other side, because once the VIX starts to calm down and markets have already corrected, we know that there's opportunity.
Right. I mean,
knowing that, of course, it's August, as you point out.
You think the VIX high 40s is where it's going to peak, or low 50s? I guess, it's up 100% almost.
Yeah. The VIX may not have a ceiling, because we know next couple of days there's also some geopolitical events on the horizon.
And Israel, and Iran, and we got politics here.
I mean, that's escalating. Some people think, well, that's going to turn into a nightmare this week.
Today, or
right.
tomorrow. I mean, we don't want to.
So I think that's why it's all coming to a head this week. I mean, to me, it's a very important week, because we know it's hard to catch a falling knife, as you're pointing out. Support levels are being broken, but mortgage rates are falling. The consumer's in pretty good shape, and the job market, I think it's very unlikely.
But so if the knife is falling, and you like catching falling knives, I know you. So the question is, at what point do you catch said knife?
I spent a lot of time talking to Mark Newton, our technical strategist, over the weekend, and I think that there is a reprieve coming this week. Like, who knows? It could even be today, right? We could open down huge, and then after 11 a.m., we could reverse higher. But I kind of agree with Joe that this is still August, and I think that markets traction really doesn't come back till October. So between now and October, it's maybe a range-bound market at best, but there'll still be opportunities.
And we could call it Bitvidia, basically. I mean, it might as well be. Bitcoin, what is Bitcoin? Gold's hitting new highs. Bitcoin, yields. People look for safety. They buy treasuries, they buy gold. People don't buy Bitcoin for safety.
Yeah, Bitcoin is still mostly a risk-on asset. And, there's potentially been lots of liquidations. I think several 100,000 accounts liquidated over the weekend.
So we could start to see that pull back sooner than expected. Also, seasonality in the markets, the sort of real zealousness of the markets comes back in sort of going into October. But the markets might know that and sort of rally into it. So hang in there, guys. All is not lost. This is a battle. We've seen, it certainly is a battle. We've seen the VIX raised to the highest level since 2008. Without a 2008 style crash, there's likely going to be a reversion of that, in my opinion. And that we've had that now coming down is likely going to push things, I think, significantly higher. So all roads lead, in my opinion, to the same destination. Hopefully this has clarified a lot of the questions that you guys have out there. A lot going on. Hopefully we've simplified it all. The only bee in my bonnet right now is, of course, the Lockheed Martin doing as well as it's done. That means there's probably something geopolitically going to happen. I don't know what. That's not my game. But on that note, I'm going to love and leave you. Don't forget to clock in to tomorrow's daily market update. We'll keep you as up to date on everything as we possibly can. Hang in there, guys. Brighter days are ahead of us. It's always darkest before dawn. That's it from me. I'll see you all in the next one.